This morning, the Scandinavian insurance company Tryg reported their numbers for Q3 2022. I'm standing here with Head of Investor Relations, Gianandrea Roberti, who promised to give us a few words on the report.
Thank you, Rasmus. Tryg reported a premiums growth of 6.4% in the third quarter of 2022, primarily driven by our biggest division, the private and commercial business. We reached a technical result of 1,832 million. This is more than 20% than the equivalent quarter last year, including the new assets, Codan Norway and Tryg. Our combined ratio was 81.1. It's been a very, very profitable business, and our Swedish business reported a combined ratio of 76 in the quarter. We had issues. Capital markets developed. It was a challenging quarter for capital markets. Equity markets dropped, interest rates went up. We have a relatively low approach to investment risk, but notwithstanding that, it was a difficult quarter for us. In general, we're very satisfied on the core insurance business. We're paying a dividend of 1.58 krona, which is up 48% compared to last year, and we still report a very robust solvency ratio of 198.
Could you also give us a little bit of flavor on how the integration with Tryg in Sweden and Codan in Norway is developing?
It's a very good question. We are now in the second quarter of full consolidation of these two businesses. There's a very big difference in size. Tryg, it's approximately 7-8 times Codan Norway, so just by that, it's our most important processes. The two businesses were very different. We are learning a lot from each other. We're learning a lot in terms of selling different products. We are trying to improve each other in terms of procurement agreements. There are a lot of synergies to be reaped. In the quarter, we're producing 97 million of synergies from this deal. Approximately 50% are cost synergies. The remaining 50% mostly claims-related synergies, but also some commercial synergies. We are repeating our overall target, which is for 900 million of accumulated synergies in 2024.
If we look at your investment return, they are negative again, as we saw in Q2. Obviously, you're being hit by stock prices and bond prices that are decreasing at the moment. But the higher interest rates, would that benefit you going forward?
It's a very valid point. We have approximately 70 billion of invested assets with the new acquisition. We try to split this in two. Around 50 billion match our insurance reserves. We basically invest in low-risk Nordic covered bonds. The remaining 20 billion approximately, it's our free portfolio, where we take a more risk-adjusted approach. In general, we have a low-risk approach to investments, but even with only 5% of total investment in equities and a similar amount in properties, those are challenging markets. Longer term, we will surely benefit from higher interest rates. Our bond portfolio will earn a higher yield, and also our insurance technical result will develop positively. But in the current market conditions, it's quite difficult, although we believe it's less difficult for us compared to a sector which has a higher investment risk than we do.
Thank you very much, Gianandrea, and congratulations on the results.
Thank you.